welcome to my channel. And in this video again, I will be suggesting you few important questions of MCO 07 financial management. And in the previous video, I told you from unit 1 to unit 10. And in this video, we'll start from unit 11 up to unit 20 and few important numericals at the end of the video. So please watch the video till the end. And one thing more, friends, like I have got a complete playlist of around 30 videos of MCO 07 on YouTube. So I will share the link, and you can watch all those chapter wise, unit wise videos for a complete preparation. Okay, unit 11 is on project financing, and here, as the name implies, project financing is a process of financing a project. And I've given here a very good example, because to complete a project, if it is a big project, we need to organize a SPV, that is special purpose vehicle, example Konkan Railways. Okay, so to construct Konkan Railways, one SPV was made, and it was named Konkan Railway Corporation Limited. So like this, this SPV takes the responsibility of completing the project. And okay, let's see the few requirements of project financing. What are the what things a company should consider before financing a project? The first one is it should be environmentally friendly. Like all the technologies and the projects, they should be they should not pollute the environment in any way. And the second one is the project should have economical value, so that whatever the investment has been made by the investors, so they should get a reasonable return out of the project. Then availability of factors of production. Now this is very important one, because like raw materials, labor, power, so all these should be available where we are doing the project. And last one is professional management. It should be well managed by the professionals, well qualified professionals. Okay, now there are few risks associated with project financing. This question quite a number of times comes in the exam. Now these are all the different types of risk that are attached with the project. Like completion risk, because you need to complete the project in a stipulated time, so that has to be kept in mind before starting the project. Then some technological risk are there. If the technology changes, because generally project takes a lot of time, so during that, if the technology changes, so that arises the risk. Then there is a risk of raw material supply. If somewhere during the project, if the availability of raw materials is not there in sufficient quantity, so that will affect the completion of the project. Then the project needs to be maintained properly, so there we are with maintenance risk. And economic value risk, that means after the completion of the project, there is always a risk that it should give us the reasonable return. Then we have financial risk, like how to fund the project. Different, we need quite a lot of money and investment for the big projects, so we need to arrange this money. Then some political risk may arises. If suppose the 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 government changes, the political parties changes, so they may have a different attitude towards the project, so that may hamper the completion of the project. And there is always an environmental risk. If the project is not friendly to the environment, if it causes pollution in any way, so that becomes a problem. So all these points need to be explained properly. Okay, then the next question is the difference between corporate and project finance. This difference is also very, very important, and number of times it has come in the exams, so do prepare this well. Okay, then we have unit 12. Unit 12 is on international business finance, and here you should revise about forex. Forex stands for foreign exchange market and financial market. And again, we can buy securities and stock on the international level apart from the domestic level. So this is forex. So this is the platform where we can buy and sell the the international stocks. A few functions are there of the foreign exchange market, like transfer of money, because different countries have different type of currencies, so they need to convert the currencies. So this function is done by the foreign exchange market. It provides credit facilities to the investors and also the companies. Then this one, hedging function. So this is basically to avoid the risk of exchange, because the convertibility of the currency always keeps on changing from time to time according to the demand and supply. So that arises the problem of risk, that is conversion risk. So that is fulfilled by hedging function. A few advantages of foreign exchange market, like it provides flexibility, it is quite transparent, so there is no risk of fraudulent activities. It also provide for options trading, so we can use all these advantages for this. Okay, now different types of foreign exchange market are there in India, like these three, like spot market, where we can buy securities. There is a future market in India. This also can be where like we can buy and sell international securities, and forward market. So these three types of forex market are there in India, which generally are important and you might get in the exams also. Okay, there are some risk which an exporter faces while dealing in foreign currency, or in financial market, international financial market. So these three currency risk are there, always there, like transaction risk, when an exporter and importer, so they when they trade, so that transaction always governs a risk of conversion, exchange rate. And there are some economic risk, if the economic policy of the countries changes, so that may affect the transaction procedure. And some translation risks, so these are very important. You might get in short notes, you might get in the short long answer. Okay, then the next question that you should revise, the techniques of managing the transaction exposure risk, that is transaction risk. So all these techniques generally a company uses for minimizing the risk, like this hedging. Then it can also avoid the risk by refinancing, and due diligence are there. So all these methods are there, we can minimize the risk. Then the relation between the transaction exposure, translation exposure, and economic exposure or risk. Exposure and risk more or less same. So you can write the difference, like their definition and their relation. They are closely related, all the three concepts. Okay. Now that we have this question, different types of international bonds, which are generally traded in on the international level. Now this one, domestic bonds, so these are also quite famous, very popular. Euro bonds, these are the most popular bonds which are traded in the international market. Then we have foreign bonds. So these three bonds are very very important, and you should know the meaning and their the way they are issued. Then the next question is instruments traded in the international financial market. So what type of instruments are traded, like which type of securities are bought and sold? The first one is a foreign exchange, that means currency. Derivative products are bought and sold. International currency market, so that also provides for buying and selling of international currency. Then euro currency is there, where we can buy and sell euro currency. Money market instruments are there. These are common, like these are also available in the domestic market, like these treasury bills, commercial paper, then certificate of deposits and bankers acceptance, euro commercial paper. So all these are instruments traded in the international market. This question is also very common in the exam, so do revise this properly. Unit 14 is on capital structure decision, and here like the company decides what is the amount of capital it should raise from the public. And in this unit you should revise this theories of capital structure, one of the very very important concept in financial management. And you should revise all these four theories, like the first one is net operating income approach, NOI. Second one, traditional approach, net income approach, NI, and Modigliani and Miller approach. All these four theories are going to play a very important role for these T December exams. So you should have a very clear understanding of all this. You might get in the short notes, and it's a must question. Like, okay, fine. Then we have this unit 15. Let's see a few important question here. Dividend policy decision. Here, like, why do firms pay dividend? Like, what are the advantages of paying dividends? So these are the important points which you should explain. In my notes, I have just written down these points. You need to explain this. Like, investors, they generally like dividends, and they send an informational signal that the company's health is good, financial health, and it acts as a tool for changing the firm's financial mix. It also reduces the management discretion, and it builds confidence among the shareholders about the good financial position of the company. It increases the demands for the stock in the market. So company should pay dividend. Then it increases the market value of the shares because uh, you know uh, when the shareholders get to know that the company is paying dividends regularly, so the demand for the shares will increase, so naturally that will result in the increase in the market value of the shares. Then the company has a stable growth. Okay, if the market value should be always on a rising trend, and it increases the market worthiness, and the company can get loans quite easily from the market, and it also acts as a regular income for the shareholders. Okay, some of the factors that determine the dividend payout ratio. Now this question is also very common question, and here these five factors should be considered. The first one is availability of growth opportunities. If the like if there are chances that opportunities are there where the company can make good profits, so it can decrease paying dividends and putting more investment in the new opportunities. Then liquidity position of the firm, like how is the liquid, like how much, in how much time the company can arrange the liquid cash. Then debt market condition, like what is the liability that the company has to pay, so that is also very important one. Then control consideration, how is the affairs of the company controlled by the management, and few other miscellaneous considerations are there which you can write. Okay, so these points need to be explained. Now dividend policy, how should be the dividend policy of the company? It can be of two types. One is stable dividend policy, the other is residual dividend policy. In stable, the company pays dividend regularly at a fixed rate, whatever, the profit may be. And in residual, it depends, like if the profit is more, the company can pay more dividend. If the profit is less, it will pay less dividend. So it goes like this. So like whatever the residue of a profit or surplus profit the company has, it can pay more dividends. Okay, then the next concept, very important one, buybacking of shares. Now this term we have read in the college level also. It refers to the repurchase of shares by a company which it had issued earlier to the shareholders. That means buying back of shares from the shareholders. Now let's see, like, what are the advantages that it offers for the company. The first one is it reduces excess share capital of the company. Okay, that means it checks, it controls the share capital. It helps to increase the reserves of the company. It acts as a it protects from the unfriendly takeovers from the companies. Sometimes it happens, like if a shareholder has more share in the company, so there are always the chances of taking over. Then like it increases the earning per share, that is PE ratio of the company. It increases the market value of the shares, and if a company thinks that its share price are low, it is expected to go for buybacking of shares. Then it can also result in saving of taxes. It boosts or increases the market price of the shares, and like that. Okay, let's move on to the next unit 16, working capital. Again, a very important unit for your revision. Now, working capital refers to the capital used in managing the day-to-day operations of a company, and the main objectives of working capital. Now, all these points you should, I've just written here the points. You need to explain them in detail. Now, the first objective is to strengthen the liquidity position of the company, to smoothen the operating cycle, to manage the cash flows, and optimum return on the investment. So all these four important objectives of working capital. Some factors that influence the working capital requirement. Again, this one is a very, a very important question, and it needs to be revised properly. All these 5 points, they should be explained properly, like how much working capital is required. So it depends on the nature of business. Like for example, if the company is a manufacturing company, naturally it needs more capital than a company who is just trading. Then scale of the unit, like what is the scale, on large scale or small scale. Then what about the method of production, whether it uses the traditional technology or modern technology. So that will decide the working capital requirement. Then technology, like if it adopts new technology, that means more capital is required. Then what about the growth prospect of the company? If the company has opportunities of growth, so naturally it will opt for more working capital requirement. Okay. Now, what are the ways by which a company can raise working capital? So basically these two methods are there. One is informal credit and the other is formal credit. And again, informal credit divided into these three types. One is a trade credit, that means buying goods or services on credit, and stretching the accounts payable, that means paying the paying period for the creditors and liabilities. So increase that, stress that. So by that also company will be in a position for informal credit standards. Then accrued expenses and deferred income. So all these are the three important informal credit methods by which a company can raise finance. Now, formal credit refers to the, the formal way, that means the systematic way of taking credits from issuing CP, that is commercial paper. It can take loans from the bank, then it can also avail for a line of credit. It can also go for unsecured and secured borrowings, debt borrowing. Then it can also take inventory loans, or assets, loan on assets from the banks. Okay, now let's move on to money market. Money market, we know, like here short term financial assets are bought and sold, and basically these securities are matured within a year, so that is why it is called money market. And here these are the important objectives. So revise this, like what are the important objectives of money market and characteristics of money market. So all these things you need to revise. And this different types of money market instruments, this is again a very important question. Just now I told you about when I was explaining the international instruments. So here also again 5 types: treasury bills, then certificate of deposits, then commercial paper, repo and reverse repo transactions, and bankers acceptance. So all these things you need to revise properly, like it's very very important one. Sometimes from this repo and reverse repo transactions you get short notes. So you have to be very very particular while preparing this. Different types of money market instruments, important question. Okay. Then we have from unit 17 cash management. Now here, like cash management, as the name implies, refers to collection, handling, controlling, and investing the cash, and the main objectives of cash management. All these points you should explain in detail. I've just written the points. Now basically cash management, the main goal is to fulfill the working capital requirement of the company, planning the capital expenditure, handling the unorganized cost, then initiates the investment, better utilization of funds, and avoiding insolvency. So these are the important objectives of cash management. And few functions also of cash management, like investing the idle cash, controlling the cash flows, planning of cash, managing cash flows, and optimizing the cash level. So again, these 5 important functions of cash management. There are some techniques where a company can manage its cash more effectively. Like, it can accelerate the collection and accounts receivable period. That means it will collect more rapidly from the debtors, and stretching the accounts payable. Just now I explained you about this. Then cost cutting, it can reduce the cost, and regular cash flow monitoring. Now the company should monitor how the cash flows, inflow and outflow both, so that should be monitored and controlled. Then wisely using banking services while you deposit the money or you withdraw the money, or even like you make any FD and all sorts of things. Then upgrading with the technology, so that should be required, because the company should always cope up with the new technology. Then we have unit 18, inventory management. Again, a very, very important unit. And here you should know like what is inventory management. Inventory means stock. So inventory management is the process of ordering, storing and using the inventory. And the main object is to avoid the overstocking and understocking of the inventories. So these are the main objectives of inventory management, like to ensure that continuous supply of raw materials is there in the company, to avoid overstocking and understocking of the inventory, then to maintain the minimum working capital requirement of the company, to reduce order cost, holding cost and transportation cost. This point is very important one. Then it reduces wastages if you are doing a good inventory management, and it helps to maintain systematic record of the inventories. So all these are the important objectives. And the next important question is this one, like inventory management techniques. Now how can a company manage the inventories properly? So these four methods are there. All these four are very important one. The first one is economic order quantity. In short, it is known as EOQ. Then reorder level, ROL, ABC analysis, and just in time inventory, that is JIT. So you might get this in short notes also, and even in the long question, what are the techniques of inventory management? Okay, so all these things you need to explain. Okay, then we have another concept for your short notes, that is what is safety stock. Now, it is the additional inventory held by the company to avoid the risk of stock out due to fluctuations in demand and supply. So, this is also known as emergency stock or buffer stock. And accordingly, you can compose your answer. You might get this in the short notes. Okay. Unit 19 is on receivables management. And here, like, you should know about the credit policy of the company. Like what is the credit policy? It's a decision on the maximum amount of credit that will be allowed to the customers, and the main objects of this credit policy is to increase the sales, to increase the profits, to maintain the liquidity, that means cash, to meet the competition. And these are the important variables. This question is also very important. Variables of credit policy. Now these are the four important variables. One is a credit standard, second credit period, third cash discount, and fourth collection efforts. So all these points need to be explained properly and learned. Okay. The next one is securitization. Now, securitization is a process of converting the debts or illiquid assets into securities to trade money. And basically, it is a process by which the future cash flow of an entity is converted in and sold as a debt instrument through certificates carrying the fixed rate to the holders. And this can be done by appointing one SPV. And basically, this SPV is funded by the investors, and they manage the assets properly and give the returns to the investors. So this is how these are few merits of securitization and demerits of securitization, and then process of securitization. So all these things you need to explain. Then you can also get one short note on SPV, special purpose vehicle. Just now I told you, explain you about this. And then we have few important numericals. Okay friends, as you know that in MCO 07 we generally get two numerical questions. So these are few important questions. Now this one is from debentures, and here the question is: a company issued 10% debentures of rupees 10,000. 50% tax bracket is there, and find the cost of debt capital. You might get this in these exams, and there are three parts of this question, like when it is issued at par, at discount, and at premium. So all are in 10%. So to find out the cost of debt capital, so we use this formula: 1 into I into 1 minus T whole upon NP. Now here KD stands for cost of capital, I for interest, NP is the net proceeds. This NP is the net proceeds, and T for tax. So all these things are given in the question, like here I is 1000, that is 10% of your investment, 10,000, so you get 1000 here, and 1 minus T is here 50% tax bracket, so divided by 100, so you get 0.5. So this is what I have written here, 0.5, and the total investment is 10,000 into 100%, so this is 5%. So this is at par, and when the company issues at a discount, so this only this one will affect that. In case of 10,000 you will write 9,000, and rest of the figures will be same. In case of premium, again 10% premium, so 10,000, 10% of 10,000 is 1,000, so add that into 10,000, so you get 11,000. So this is how you're going to solve. The next question is here from shares. Again same similar type of question, only the difference is the formula. To find the cost of debt capital, it's bit different. To find the cost of share capital, especially this preference share capital, the formula is different. So you need to learn this formula, because without formula it won't be possible to answer these numericals. Okay, one more like very common numerical that generally comes in the exams. In the June exam also you get this type of numerical, where sales is given like 7,50,000, variable cost will be given, fixed cost will be given, some debt is given, interest on debt will be given, and equity share capital is given, and you will be required to find the different types of leverages, like this OL, operating leverages, financial leverages, and total leverages, and maybe a return on investment. Again, you need to work out on the formulas. And before that, you should find out first this contribution, EBIT and EBT, because all these things will be applied in the formula. Because when we find out operating leverage, the formula is contribution to IBIT. So that is EBIT का full form होता है earning before interest and tax, and EBT stands for earning before tax, and contribution is sales minus variable cost. So you need to understand and learn these formulas, and accordingly you can just put these values in the formula and get the answer. Okay, so now fourth one is here. This one is related with the project, like in this question there are three projects given here, and the cash flows are given in the subsequent years, like this C0, C1, C2, all these are cash flows. And that is in the, this is suppose first year it is minus 25,000 in both the cases, and project A there is no cash flow. Second, project B 15,400, 20,700 for project C, and like that. So this is the question, and you may be asked to find the NPV, or you may be asked which project is to be selected and why, or which is the most lucrative project. So you need to find out the NPV of the project. To find out the NPV, you can use the formula which I mentioned earlier in the time value of this thing money, that means second unit. So by that you can find out this. Now sometimes what happens is this annuity of the figure will be given to you. If not given, you can ask the invigilator, so he will provide the annuity table. So you just need to multiply that with the cash flows and add them, so you get this NPV. And again, like for project B, the same case, like you will find the NPV. So finding NPV, again you need to multiply with the value that is I've mentioned in the theory part. Okay, then again, like this is also a bit very important one, this question number 5. And here again, like a company needs 5 lakh for its new plant, and it issues 50,000 equity shares of 10 rupees each. And if the company is earning before taxes are 10,000, 20,000, 40,000, 60,000, and 1 lakh after 5 years. So what is the earning per share? And here corporate tax rate is 50%. So these are all the 5 years summary here. This is the solution in fact. And first this EBIT is given, earning before tax. All these figures are given in the question: 10, 20, 40, 60 and 1 lakh. And tax bracket is given 50%. So 50% of 10,000 you get 5,000, and when you subtract that you get the total earning 5,000. And the number of shares issued is 50,000, so EPS is 0.1 when you divide that. So like that, in the second year we can find the EPS of, that is EPS stands for earning per share. So this is how, like for the second year, third year and fourth, fifth year. So this is the solution. And again, like this is of debentures, and you have to find the cost of raising the debentures. And again, like this type of question also comes quite a lot of time, that it is also like similar to that project. So many examples are also given there in the IGNOU book, so which you can revise for your exams. So friends, these are few important questions which you should revise for the exams. And I hope these videos are going to help you in the preparation and scoring good marks. Thank you very much for watching this video.